So finishing up chapter 6, couple of questions regarding capitalization versus expensing, and then talking briefly about gain or loss. And I know we've done this before, so won't spend too much time on it. Looked at the homework and it's all just calculations of depreciation. So you have all you need now to do the homework. If you have any questions on that, let me know. All right, so I'm gonna jump right in, go into the in-class questions. And so we're talking about capitalizing versus expensing. And capitalizing is recording the costs as part of the asset, increasing the historical cost. Whereas expenses flow through to the income statement. Okay. And so essentially, when we're talking about what should we capitalize, we want material expenses that change or improve the asset to extend its useful life or modify its use. Expenses are sort of the maintenance and utilities plus normal repairs that don't change the asset or its useful life. So we have question 6-11, and we have these expenditures, and we have to decide whether or not we want to capital or we should capitalize or expense them. So take a minute to read over them. It's in, somebody asked how they access the recording from the last class, and I'm pretty sure I put it up right after class, but if I did, it'll be in Blackboard under the course materials, class notes, and then chapter 6. Okay. So it says the company incurred the following expenditures related to the purchase and use of a new building that will be used as the growing company's corporate headquarters. Put an X in the appropriate box to indicate whether they should be capitalized or expensed. All right. So first one, $560,000 spent for building materials. Pretty material So big deal, going to change the life of the building. $256,000 spent for labor costs. So part of improving the building, pretty material amount. Going to capitalize that. The architect's fee, going to capitalize that. Rent for equipment used during construction. So we have this building that's not quite ready yet. And so part of the cost to get it prepared is going to be labor, building materials, and we're going to need equipment. So that gets capitalized. Now, $52,000 in annual utilities costs to operate the building. So even though this seems like a material amount and it hits that threshold, it's part of the normal operations of the business. So we would expense that portion of it. So capitalization, somebody asked, what is the definition of it? And essentially recording the costs as part of the asset. So is that a textbook definition? They might be slightly different, but I think that's fairly accurate. Essentially, they have this building that they acquired, and when you capitalize something, you put it on the books as an asset and you depreciate it over the long term. So these costs, whatever they paid for the new building, would go into the costs of the building. So this 560, the 256, the 78, we're going to get somewhere close to $1 million, let's just say, because I don't want to punch up the math right now, but that would be the cost of the building. And then they determine the useful life of the building, and then they would depreciate it over time. $90 to fix a broken window, routine expense, especially if you have children. All right. $230 cost to clean a stained rug, expense, and $3,900 in annual janitorial costs. And that's just to keep the building clean. So that's part of the routine maintenance that should be done on the building. So those would be expensed. Any questions there? Okay. All right, so this will be for you to practice. Number 12. All right. So we're working on number 12, incorporated following expenditures and purchase or use of machine, which was placed into service on January 1, 2011. Determine the total cost that should be capitalized in the machine account. And give a total. You don't have to explain which costs. So again, put the total in the chat and privately to me. Seeing the answers start to trickle in chat, so give you about another minute. That's assumed, Markela. I think we all are. Okay. All right. So we'll look at it. Okay. So now when we sort of walk back up here and we're talking about capitalizing versus expensing, this is kind of, all right, determining what's going into the process. And there's one sort of overriding rule in terms of a long-term asset, that historical costs. So for long-term assets, we capitalize all costs necessary to get the asset in place and ready for use, which, remember, that includes training of employees and installation. So that might clear it up. That's a reminder from before. These capitalized things will both work once the asset exists and also making changes to the asset. So back down to this question, and most of you got it right, but a few of you might have missed the small one. So we've got the price. We know that that's going to be included. We've got the shipping costs. And then the inspection and handling would be considered, would we consider that necessary? And that's kind of a up for grabs. Now, if the machine was already in service and this was part of an annual plan, we would not include that. But because this has the moving and handling, it's part of getting it into place. And then the 12,300 for finishing the installation and testing it. And so I believe total wise, it's 185,800. And then the power and operating costs for using the machine during the year would be expensed. Any questions? Throw out the poll. Remember, if you have a question, please type it in the chat. Or come on voice and say hello. So all I did was sum up the answers in bold to get the 185,000. End that polling. Share the results. And then I'm going to close it down. Okay, part 2 says determine the total operating expenses for the year ended December 31st, 2011. So we have the power that we know is part of that. And it says, assuming it has a 5-year useful life and an $8,000 salvage value. And so we'd have to calculate depreciation expense. Now it doesn't say straight line, but we can calculate that based on straight line. And so we take the 185,800. We subtract out the $8,000 salvage value. And I think that's 177,800. And then we divide that by 5 years. And we end up with 35,560 per year for depreciation. And then the operating expense is equal to 43,000. Okay, now moving on to the next topic, and this is just hopefully a reminder that in order to calculate a gain or loss on sale of a long-term asset, you have your book value, excuse me, you take your cash or proceeds received and you subtract out the book value. And book value, hopefully you remember from earlier, is the asset historical cost plus any additions, capitalized, less the accumulated depreciation. Okay, so for...
Can you scroll back up like a little bit?
Yep.
Thanks.
Sorry. So for this question, what we have to do, and I'm going to put this actually up here in a note, we have to make sure depreciation is up to date. So in some questions, we may need to calculate partial period depreciation.
If you had salvage value, would you still have to subtract that out from the cost when you're doing the book value, even though you're selling it beforehand?
So by kind of setting the salvage value, you're assuming at the end of that time, you're going to have a book value that's approximate or is exactly that salvage value. And so in an ideal world, your estimate would be perfect. And at the end of the time, you would sell it for that. But there's two things that can be different. A, you can get a different amount of money or proceeds at the end of that time because either your estimate was bad or the market changed, or you can sell it before or after. And so depreciation wise, salvage value, they're all taken into account. So we don't have to worry about the salvage value again. It's in as part of that book value.
Okay, thank you.
You're welcome. All right. So with this question, it says it sold an asset for $8,500 in cash. So proceeds. And the reason I say proceeds versus just cash is because a lot of times you'll get a trade value or you'll swap it for something else. And so you might not necessarily get cash. All right. It had a historical cost. So we book value 30,000 minus the accumulated depreciation of 20,000. And so we have a book value of $10,000. So 8,500 minus the 10,000, and that equals negative 1,500. So that's a loss. All right. And so our answer would be C. Okay.
Professor,
Yes.
if it had $10,000 worth of value left and they sold it for 8,500, aren't they making 1,500 off of it?
No. So they're estimating that it has a value of $10,000, but they're only getting 8,500.
Oh, right. Okay.
All right.
Thanks.
You're welcome. And again, remember, these are estimates, markets change. I'll give you an example. Hopefully my wife can't hear me. She was just out getting a soda. I bought a Toyota Tacoma a few years ago and I paid $18,900 for it. And we had it, drove it about 10,000 miles, and she zigged when she should have zagged and ran over a fire hydrant. And if I was sort of a business depreciating that vehicle, I'd say, okay, I have 5 years on it. And after 2 years, I would say, okay, probably worth $14,000. Well, because of the market for used pickup trucks, it ended up being worth $18,000. So they ended up cutting us a check, was able to pay off the loan, the taxes, and the insurance for $18,000. So even though you're going through this process and you're doing your best to estimate it, you don't know exactly how things are going to turn out. There's market factors at play there. Okay. So let's take a look at 14. And so this is hopefully one that you all can do. So we've got, I'm going to change them to numbers. Got 6 transactions here. And we're going to determine the net amount of cash. So we're going to add up what we got and subtract what we spent. So inflows versus outflows. So I'd like you to try this. First part here and type the answers in the chat. So hopefully this will help you understand that, Juliana, as we go through 14. Yeah, I'm gonna go through and explain it. Check your signs as you're entering it. Someone got the right number but the wrong sign. Give you another minute. Not getting as many answers on this one. If you got an answer, type it in the chat to me privately. Okay, I'm gonna go ahead and jump in there. Seemed like there was a lot of confusion on this one, and you really have to filter out when they're asking this. So we're really thinking about cash. Excuse me. And I'm gonna go back to the ABCs so that I match this one. So really what we want to do is pick out each part of the cash and try to ignore all the other noise. So we have 134,000 in cash there, 289,000 in cash there. We sold it for 77,000 in cash there. $20,000 in cash here. $13,000, we're assuming that's cash. And then land cash, oh, that one didn't bold for me. Okay, so we got 1, 2, 3,
Professor.
4, 5, 6. Okay, yes.
You wouldn't be generating the cost or loss for the transactions? Or you would be?
So you're not figuring that out. You're just looking at what's happened this year. We are going to do that for the second part, but I just wanted you to do the first part. So determine the net amount of cash. Okay. So here, purchased. So the first part is an outflow of 134,000. B, invested in. So basically that means we purchased as well. So that's minus 289,000. C, sold 77,000. So this is a plus. We got sold. D is also sold. 20,000. E and F are sold and sold. So 13,000 and 220,000. And that gives us a total of minus 93,000 or cash outflow. Okay. All right, so that's our first part. Now, Dylan, we got to answer the next question, and I'm going to shrink this up a little bit so we can keep as much. Oh, let's see if I can hide the ribbon. All right, get a little more screen here. And we need the ones that have a gain or loss from each of the transactions. So these first two, we don't have any gain or loss from the transactions. So no gain or loss. No gain or loss. See historical costs, so we're book value, 350,000 minus 200,000 equals $150,000 book value. Proceeds, 77,000 minus the 150,000. And so
73.
73,000. Thank you, Dylan. Loss. D, sold an old piece of factory equipment for $20,000 cash. All right, so book value, 560,000 minus the 430,000 in accumulated depreciation equals 130,000 book value. Proceeds, 20,000. So minus the 130,000 equals net 110 loss. E, sold office furniture for 13,000. So book value, 30,000 minus 15,000. And so we have a $15,000 book value. Proceeds, 13,000. Oh, sorry, typo. And so we have minus 15,000 equals minus 2,000. And that's a loss. And then F, sold land for $220,000 cash. Land was purchased at a cost of $170,000 5 years ago. So proceeds, 220,000 minus the 170,000 book value. Remember, land doesn't depreciate. And so that's 50,000. So now we have to total everything up. So you have 183, 185, 50. So $135,000 loss. Okay. So take a second to look that over. Don't jump on the poll right away unless you completely understand it. Look it over. And then if you have a question, click yes and type the question in the chat. If you don't, click no and we will move on. I have one yes. So if you could type your question in the chat. Awesome. So the question asked is how come the first two don't have a loss? And the answer is because all we did was buy them. We haven't sold them yet. So we don't know what's going to happen in the future. But as of right now, we just own them. They're an asset listed on our balance sheet. Okay. All right. I'm not sure I understand the second question. Juliana, it says that it gives us the cash proceeds, but how do you find it? You'd have to be told that in a question, unless they told you there was a gain or loss and it was from cash. But basically, cash has to be specifically referenced. The one time I think I made the assumption on the question was they sold the office furniture for $13,000. I made the assumption it was cash, but other than that, everything else pretty much says cash. Oh, well, I actually made the assumption under C as well. One could argue that the question was not perfectly written and that those other two should say cash as well, but I'm going with the assumption there. Okay. Now, normally I would jump down to sort of the big problem, but your homework largely focuses on calculating depreciation. And so I want to do as many of those types of questions as possible. Now I'm going to skip the straight line because that's pretty easy. I'm going to move to the double declining balance method here. And so again, our formula for double declining balance is 2 times the straight line percentage. And so it tells us that it's a 4-year useful life, then there's no estimated salvage value. So that helps us with knowing in that last year, we don't have to subtract anything out. We're just going to take the remaining depreciation. So we have 100% divided by 4 years, and that tells us the straight line depreciation rate is 25%. Okay, so now we're going to take 2 times 25%, and that's 50%. So for each of those years, 50%, 50%, 50%, and then the remainder. And then the book value, 120,000. depreciation expense for the year is 50% of 120,000, so 60,000. Accumulated depreciation at the end of the year, 60,000. Now my new book value is going to be 120,000 minus the 60,000. And so it's going to be 60,000. And so the depreciation expense, 50% of 60,000 is going to be 30,000. My book value here, 60,000 minus 30,000 gives us 30,000 book value. So 50% of that, 15,000. Sorry, this is accumulated depreciation, 90,000, and then we add 105. So we're adding the depreciation, the 60 first year, the 30,000 added to the 60, the 15,000 added to the 90 each year. We have the remainder, 30,000 minus 15,000. So our book value is 15,000. We're taking the full amount, 15,000. And so accumulated depreciation at the end of the year is 120,000.
This double declining method, is the rate always going to be 50% on this?
Nope. So it depends on the number of years, right? So if your useful years is 8, so let me scroll down a little bit past this. So let's say we've got 2 years. And so 100% divided by 2 would be 50%. Let me add another column. Okay, so years, calculation, straight line, percentage, double declining, percentage should be SL times 2, 100%. So it's 4 years, 100% divided by 4, 25%, 50%, 8 years, 100% divided by 8, so like 12.5. So this would be 25%, 10 years, 100%, divided by 10, so it's 10%, so this would be 20%, say 20 years, 100% divided by 20, 5%, 10%. Okay, so does that help, Dom?
Yeah, but now my question is, why does double declining depreciation exist at all? Like, what is it used for?
Uh, so in an ideal world, you would try to match up your depreciation expense with the usage of the vehicle. The reason that double declining balance exists is because, and I shouldn't have said vehicle, I should have said asset. And so when you're thinking about a vehicle, when is most of its useful life used up?
Like, early on, right?
Right. And so if you have an asset that is going to be used up early on, then this would match that up better. And so that's why it's done like that. Other than that, not necessarily a good reason for it. There are actually 2 or 3 other acceptable depreciation methods that we're not learning that are a little bit more complicated, but they're accelerated depreciation as well. And then there's tax depreciation, which is accelerated tax depreciation. And there's one called sum of the years digits. And so there are other methods that are acceptable, but basically the point is to try to match your expense with the actual asset.
Gotcha. Like while you're using it.
Correct. And then you say, well, why not use units of activity for every asset? And the answer is just because of the record keeping. In the future, that may be something that they do use. To me, straight line is the one you'd say, well, why do you really have that one? And I'd say that's just because of simplicity of the calculation. Has somebody else that types of question in the chat? How would I decide on number 3? So, okay, let's go back real quick before class is over. It says, which method would report greater net income to the shareholders for 2011? So the short answer here is, if it's going to be a greater net income, I want a smaller depreciation expense. Now, straight line depreciation expense, $120,000 minus 0 equals 120,000 divided by 4. So that's what, 30,000. And so our depreciation expense, 30,000 in that first year. And so we know that straight line would provide us with greater net income. And that's probably the reason for why straight line exists. Not only is it simple, but it also gives a higher net income. Now, over the life, which method results in a higher amount of total depreciation? Answer is neither, right? You're going to get to your historical cost minus your salvage value over the life of both of them, unless you were to sell it early, in which case that gain or loss is going to wipe out that accumulated depreciation in total anyways. Now, I know class is over. You probably have to go to another class. I'm going to do a separate video. I want to show how it's reported in the financial records. So keep an eye out for a second video in that content module in the chapter 6 for just reporting this piece of it. I know it doesn't, I'm pretty sure it doesn't happen in your homework, but I know, or I'm guessing it's likely you'll have a question on the exam 3. I haven't made it up yet, but usually we ask you to record how they're reported in the financial statements. So if there are no other questions, you all are free to go. Have a great day and a great weekend, and I'll see you on Monday. Don't forget to do your Chapter 6 homework, and if you have any questions, message me.
Thank you, Professor. Have a good weekend.
Thank you, too. Thank you.
Thank you.
Take care.
Thank you.
Professor, is the extra credit still available?
You have to look at the Pearson date. I don't know what it is off the top of my head. I know it's coming close, so I think it's tomorrow, but check in Pearson just to be sure.
Okay, thank you.
You're welcome, Bria. Have a good weekend.
You too.
Did you have a question, Juliana? Yes, absolutely.